All right, we're on chapter 10. We're on property, plant, and equipment and intangible assets acquisition. Okay, so we're going to jump on in here. And the first slide gives us our list of different long-term revenue producing assets. Okay, we have a big category of property, plant, and equipment. Those are really in this section, probably pretty self-explanatory. When we do get into natural resources, a little bit more complicated, but intangibles can be really complicated and how they're bought, acquired, and different things like that. Okay, so let's jump on into property, plant, and equipment. They give us an example here from Microsoft Corporation, and this is just looking at their property and equipment. You can see land, buildings, leaseholds, computer equipment, furniture, and all of that. And they just have one big accumulated depreciation account. It's probably in their records divided out more specifically to each one of those assets, but this is just the financial statements to the public. It is probably very aggregated and put together. Okay. So then they have the intangible assets. So they have technology based, customer based, marketing related, and contract based. So those are intangibles. They don't show any accumulated amortization for those, but there would be. All right. So here is a really good, I think it's these two slides give you a lot of information in very concentrated form here. This is one of those slides I always say is really good to go and review right before a test because there's a lot of meat on here. Okay. So, but we have slides going through all of these. So we're going to jump on in. Oh, there's three slides. Sorry. All right. What cost? So we are on US GAAP. We use historical cost, what we paid for the asset. That is what we're going to record it on our books. Okay. Some of y'all are in international accounting. That's a little different when it comes to them because the initial might be just like GAAP, but they can write things up. They can write assets up. We can't do that. Okay. Not in US GAAP. Okay. So I love how they say a purchase price, then all expenditures necessary to bring the asset to its desired condition and location for use. So anything to bring it to its intended purpose, that is what we're going to capitalize that as well. Okay, so it's not just the purchase price. I know probably at all three principles, we pretty much just had the purchase price. We didn't muddy up the water too much with a lot of those little bits and pieces. And then we got to chapter 10 and we did those long-term assets. And we kind of talked about this. So some of this should be a review from that. Okay. So let's talk about equipment. It's going to be the purchase price, sales tax, sorry. We are going to have transportation. Okay. If it's needing to be transported from one area to another, then that cost of transporting needs to be added into the cost of the asset. Okay. Also, installing and testing this equipment. I always think of like a module or a section of an assembly line. You don't just put it on there and say, oh, it's going to work perfectly every time. You're going to test it. Any of those resources you use, lumber, plastic, or whatever, if you any of those things you use to test will be capitalized as well. Okay. And then that very broad definition, any other cost to bring the asset to its condition and location for use. Okay. So they give us a little example here. This is Central Machine Tools purchased industrial equipment to be used in the manufacturing process. The purchase price was $62,000. Central paid another 1,000 to transport the equipment. They're wanting us to find what is the capitalized cost. So we know 62,000, which they've already got right there. We know the 1,000 freight and handling. And then $300 for shipping insurance. That was insurance while it was in transit. And then, in addition, the equipment had to be installed and mounted on a special, sorry about that, on a special platform built specifically for the equipment at a cost of $1,200. We're adding that as well. After the installation, several trial runs were made to ensure proper operation. The cost of these trials included wasted materials of $600. So we're going to capitalize $65,100. Okay. These are those concept checks. I'll pause over it, hover it just a second. So if you want to pause the video and work that, you are more than welcome. Okay. Now let's look at cost of land. Okay. It's going to be the purchase price, closing cost, attorney, title search fees, real estate agent commissions, back taxes, liens, mortgages, or other obligations. Any expenditures to clear, field drain, or removing an old building has to be included in the cost. This is the one that a lot of students get confused on. So you buy a piece of land, it's got an old building on it. You don't plan on using the old building. You plan on tearing that old building down and building a new one. Some students want to think that that tearing down of the old building will go into the cost of the building. It does not. It goes into the cost of the land because we had to clear that old building down to get the land to its intended purpose. Okay. Sometimes there is proceeds from salvage materials from like a building. I know it's been a long time ago. Emmanuel Baptist Church in Little Rock used to be right there close to Children's Hospital. They've got that big new church they've built down there in West Little Rock. But a friend of mine worked at Children's Hospital at the time. They were letting them like go in and they buy things out. So like some of them bought some stained glass windows and things like that. So if there's some stuff that gets salvaged out of something like that, those proceeds would bring down the cost of the land. Okay. So maybe if it's a whole lot of acreage with a lot of timber and you're going to sell the timber, have the timber cut down and sold, and then you got some money for that to be able to build a building. So that would bring down the cost of the land. Okay. All right, we have an example here for capitalizing the cost of land. We have Buffalo Metal Company purchased a 6-acre tract of land with an existing building of 500,000. The company plans to remove the old building and construct a new one on the site. In addition to the purchase price, the company made the following expenditures at closing of the purchase: title insurance, commission, delinquent property taxes, and current year property taxes. Okay. The current property taxes included 4,000 of delinquent taxes paid by Buffalo on behalf of the seller, as well as $2,000 attributable to the portion of the current fiscal year that remains after the purchase. Okay, so then they go, before we read any more, let's go ahead and come down here. We've got their purchase price, title insurance, commissions, delinquent property taxes, which was the 6 minus the 2, and then removing the old building. That's right here. Okay, so Buffalo paid a contractor $10,000 to tear down the old building and remove it from the site. An additional $5,000 was paid to level the land. Both of those are included in the cost of the land. So our cost of our land is $538,000. Now remember, your land is not depreciated. Okay, so if when you're adding cost to this asset, you've got to remember this is going to be an asset on our books for a very long time, as long as we own that tract of land. Okay, because remember, land doesn't get depreciated. Everything else does, though. Okay. The next thing we're going to talk about is land improvements. These are everything on that piece of land that is subject to decay. Um, Landscaping. I know you may think, oh, those plants could live forever. They can, but sometimes they grow out of control and they have to be ripped out and more put in. Or, there's lots of things. I have a house that we have landscaping around, and like we're always doing stuff with that every summer. There's always something to do with it. Okay. Not like the land that my house is just sitting on, like I don't have to really do anything to that. Okay. So this parking lots, driveways, private roads, fences, lawn and garden sprinkler systems. Okay. So all of those are capitalized and then depreciated over the life of that land improvements. They sometimes call those LIMP, like land LIMP, LIMP account. So then we have the cost of the building. Okay, I would pretty much know purchase price, realtor commissions, and all of those different things. Okay, the thing that is very specific to a cost of a building is interest. Okay, they may be going to tell us this on another slide, but I want to mention that right here. If they have a construction loan and they are like building the building on their own and they have interest accruing on a construction loan, that interest gets plugged into the capital or the cost of the asset. Okay, the cost of the asset, because that's part of bringing it to its intended purpose. Okay. Then cost of natural resources, we have all the same things, but this is for timber tracts, mineral deposits, oil and gas. If we purchased it, is purchase price any other cost necessary to bring the asset to condition and location of use. If developed, then we're going to have other things: acquisition cost, exploration cost, development cost, and restoration. We'll get a little bit into restoration later on, which is right here. Here we go. Asset retirement obligations. This a lot of times does arise when we have an oil and gas exploration company because usually when they go in there and drill, things are not the same. Okay. And they may be required to make it look all the same after they're done. Okay. So they could have this asset retirement obligation. Okay. So there is provisions of standards to address the ARS scope recognition, measurement, and present value calculations. We're doing a lot of stuff with this one, okay? So the Canyon Mining Company paid $1 million for the right to explore for copper deposits on 500 acres of land in Pennsylvania. Cost of exploring for the copper deposit totaled 800,000, and intangible development costs incurred in digging and erecting the mine shaft were 500,000. In addition, they purchased new excavation equipment for the project at a cost of 600,000. After the copper is removed from the site, the equipment will be sold. Canyon is required by its contract to restore the land to the condition suitable for recreational use after it extracts the copper. So it's got to look just like they've never been there. Okay. So the company has provided the following three possibilities of cash flows. Okay. The first one, it's going to cost us 500,000, 30% probability. Next one, 600,000, 50% probability, 700,000, 20%. Right here, they give us 8%. We're going to need that because we're going to discount these cash flows down. Okay. So the first thing we're going to do, we know that the $1 million, 800, the development cost, and then we have the restoration cost. How do we get that number? We're going to come down here and look at it. All of those three different probabilities, we're going to take 500,000, multiply it times 30%, gives us 150. 600 times 50%, 30,000, 700,000 times 20%, 140. Okay, so we end up with a total of 590,000. That's what we expect to pay. Is it 3 years down the road? Was it 3 years? I can't remember. I think it is 3 years. Okay, yes, because their N is 3 right there. Okay, so they went and found this present value number or factor on those present value tables. If every one of you learned how to do that calculation on your TI-84, so you can do that and plug that number in and figure that out. It's going to help you on the test to be able to do that on that TI-84 calculator. So this is the present value of the 590,000. Okay, so the difference between the two is what they call accretion. Accretion is kind of like interest expense, but it's gradually having expense over the time period. Okay. So that's where the 498,360 came from. And then our total cost to be capitalized is that big number right there. Okay. So they're going to have an asset of copper deposit of 27,683, 360. The cash spent was 2.3 million. We could have added, I think it's these three. We added those three up. We've already paid for those. We have not paid for the restoration cost. We're not going to pay for the restoration cost until the end. Okay. So they put that in an asset retirement liability. It is a liability account. Okay. That is the present value of that amount as well. Okay. They also bought the excavation equipment and credited cash for that. Okay. They're probably just going to depreciate that over 3 years. Okay. All right. So let's talk about this asset retirement obligation, this accretion. So here we have this is, if you think back to when we did amortization tables, that's exactly what this is. Remember, this would be called the carrying value. So we take the 490, I'm sorry, 468, 360, multiply that times the 8%. They did the calculation right here. That gives us 37,469. Okay. We're going to debit accretion expense and credit that asset retirement liability. And we're going to make this exact same entry at the end of every year for this asset. And when we get done, that asset retirement obligation will have $590,000 that we are going to have to pay. Okay. So you can see we got that. Then we're going to come down here. So it says if the actual restoration costs are more or less than the 590,000, we'll recognize a gain or loss on the retirement of the obligation for the difference. Okay, so for this example, we're going to assume or suppose the actual restoration cost was 625,000. You know what? We don't go back and change that estimate. We made the best estimate at the time when we made this estimate for this 3 years ago. We're going to pay the 625,000, no big deal. Okay. But we're going to debit that liability for the 590 because that's what it's being carried at. We're going to credit 625,000 and then that $35,000 difference comes to loss. They probably call it loss on asset retirement liability. Okay, that loss will go straight to the income statement, whereas all these other ones gradually went to the income statement each year. Okay, so that's a little bit different than what we have done in the past. Okay, all right, let's talk about intangibles. Okay, intangibles, they lack a substance. Companies can either buy them or develop them. Okay, buying them is a whole lot easier to come up with good numbers. If they are developing them here in the US, research and development has to be expensed as incurred. It cannot. We don't know, like if there's a new patent or something coming out over, I always think of pharmaceuticals. If there's a new drug, they don't really know. Some of those drugs, they might spend 20 years developing. Okay. They don't really know if it's going to yield them anything, but US GAAP is requires them to expense it as incurred. That's why a lot of times new medicines do cost a lot of money because those pharmaceutical companies are trying to recover some of the money they spent over that period of time that they spent, research and development. Okay, I know pharmaceutical companies can be a lot really controversial, but that's the gist of it. Okay, if we don't, like, I know a lot of politicians want to go in and lower those, but that kind of scares me just a little bit because if they can't recoup their money, then why would the pharmaceuticals be um, encouraged to develop a new drug? Okay, they're not going to be encouraged to develop a new one because they're not able to get their money back out of it. So I feel like that kind of might. I mean, I just wish insurance companies would pay what they're supposed to be paying because we pay a lot of money for insurance, but pharmaceuticals, whether you think they're good or bad, I mean, there is a lot of good meds out there, and I hate to say they're all bad because they're not all bad. Okay, so some of these intangibles have a finite useful life. Then we're going to amortize them. Some of them have an indefinite life. Goodwill is one of those that has an indefinite life. We do not amortize it. We'll test it. We'll learn how to test it for impairment. Okay. So typically, if they're internally generated, we can't start accruing any cost until we know it is a legitimate thing and that it's going to be able to provide us future economic benefit. And sometimes that's hard to decide. When did you find out it was going to be something that you could go forward with to define that line between research and development and actually developing that intangible? Okay. Here is another good slide that's got a lot of information on there. We got patents, copyrights, trademarks, and franchises. They give you information about each one of those. So yes, a patent will be granted for 20 years. but a lot of times it's not good for 20 years. So they may tell you in the problem, they may say a patent that has a 20-year life will only be useful for 5. Then you only amortize it for 5. You're not going to amortize it for 20 because you're not going to get 20 years worth of use out of it. Okay. Copyrights are granted, and they are to the life of the creator plus 70 years. Okay. Trademarks registered with the U.S. Patent and Trademark Office for a period of 10 years. Okay. Franchisor grants it for a specific period of time to the franchisee. Okay. Let's talk about goodwill, and we're going to finish this video up pretty quick. Okay. So goodwill happens when we don't really know. We don't really know. We can't really attribute goodwill to any one thing. We can kind of guess. Clientele reputation could be trained employees and management, or a favorable business location could be a reason that goodwill happens. Okay. So what happens to goodwill? You are looking at whatever they're willing to pay, the acquisition price. Okay. Then they're going to take and subtract the fair value of the identifiable net assets. When we say net assets, remember accounting equation, assets equal liabilities plus equity. We will take the assets and subtract the liabilities, and that would give us the fair value of net assets. Okay. Okay. So they're willing to pay more. So we can look out there at the tangible things that we know are worth a certain amount, and then the acquisition is going to be for more. Okay, it's going to be for more money. Okay, that's when we know there's some goodwill. The company that created the goodwill cannot record goodwill because we can't measure goodwill until a purchase of the entire unit or the entire company has went through, then we can identify goodwill. Okay, so they give us a problem here. So it said the Knight Corporation acquired all of the outstanding common stock of Ryder Corporation in exchange for 180 million. So 180 million, that's our acquisition price. Okay, they said they assumed all the liabilities, which had a fair value of 120 million, and the fair value of the identifiable assets of Ryder are as follows. So they had receivables of 50, inventory of 70, equipment of 90, and a patent of 40. Okay, so they had, surely they'll give us, yes, 250,000 was identifiable fair value of the assets. Okay, so 250 minus the 120 liabilities gives us 130 million. But they're willing to pay 180 million for assets that are worth 130. Okay. There's something there. We don't really, sometimes we really just don't even know what it is, but they were willing to pay $50 million extra in goodwill. So we attribute that to goodwill. Okay. So they give us the journal entry, which is good because I don't know that we've ever done the journal entry for that. We would debit you look at all of these assets here. They're debiting every one of those assets. We're going to credit the liabilities and the cash that we used. Okay. And then the difference between all that, your journal entry should balance out. You should not get a negative goodwill. There's no goodwill if that's the case. Okay. That means that you paid less, you got a good deal. And remember in the well, I think we're going to do that in the next video, where we have a lump sum purchase where you're buying a bundle of goods for an amount. Okay, so you will never ever see goodwill over on the credit side like that. All right. And our last slide for this video is this last concept of goodwill. If you want to pause the video and work on that one, you're more than welcome to. But I will see you in the next video.